It is literally impossible to succeed as a day trader if you don't have a good understanding of liquidity. So, this third episode of my Liquidity Bootcamp is going to be centered around draw on liquidity and the best types of it. So, we've already covered liquidity as its basic definition, we've covered internal range liquidity. Now, we're going to be covering draw on liquidity, basically, how you can use liquidity to have flawless targets for whatever trades you're taking. So, let's get right into the video. I'm going to go over 3 main concepts today about draw on liquidity that I really like to use. Now, to simplify draw on liquidity for you guys, it's most useful, and you guys probably learned a bit about this if you watched my first video defining liquidity, but it is most useful when there's only one obvious draw. Now, what do I mean by that? Well, right here, you can see we have a collection of lows and a collection of highs, right? So we have buy side and sell side. You're going to be better off trading only once one of these sides is taken, and then the other side becomes the obvious draw on liquidity. So right here, say we take out this low, so we sweep liquidity. So our sell side liquidity in this range is gone now. What do we have left? We have all of this buy side up here, because not only do we have the original swing high where people had their short stops, but we also created another lower high, so people probably trailed their stops, or people probably got short on this move here and have their new stops resting in the same area, which means that this area became a stronger buy side draw on liquidity because we're going to have even more stop concentration there. And then that's when you're often going to want to see market run up and take that out. So that's why this, liquidity can be used as such a good target. So now that we got the definition of draw on liquidity out of the way, let's go over the first exact type of draw on liquidity that I really like to use for my trades, and that is relative equal highs or lows. And it's pretty simple, and it's actually kind of related to the little squiggly line I just drew to show you guys the draw on liquidity example. But this is what relative equal highs are. It's just a bunch of buy side liquidity, right? A bunch of swing highs that are in the same range that are very close to one another, but the key is that they cannot have taken each other out, right? So if this wick right here was all the way up here, these would not be good relative equal highs because this was already a liquidity sweep. So it's not going to be a draw anymore because you've already had these sell side stops that were up here taken, right? If you have this wick happen up here. But because it doesn't, we now have this conglomeration of sell side stops above every one of these highs. Now, that's relative equal highs, and if you're longing, that's going to be an amazing target most of the time. However, you can see right here, what do we have? Relative equal lows, right? A ton of swing lows in the same range, in the same area, right? We have all these swing lows and they're very obvious. So what do we want to do? Well, we want to wait until one of these sets is taken and then target the other, and it's going to give us a very high conviction trade, right? So now you can see we've had this move up. We take out all of these swing lows in the range, and there's no more very close. So at this point, we can say, all right, we've swept out liquidity. Now we have a very high conviction long target to buy side liquidity, right? Which had yet to be taken. So let's see what happens. We get a pretty clean reaction, a fast bounce, and we take out all of the buy side that was in question, only after we take out the sell side. So that's why I continue to harp on the point of, if you have a lot of relative equal highs and lows, you want to wait till one set is taken and then target the other. But it's a stronger target than just one swing high. For example, if this was the only swing high in this range, yeah, you might still target it when you take sell side. But because we have this set of swing highs in addition, you just have so much more liquidity built up in this area, especially once market manipulates away from it. Real quick, if you guys are enjoying this video, make sure to like and sub so that you don't miss my other videos in this bootcamp series and my other videos in general, where I try to help you guys become better traders and share my strategy and trading recaps. Enjoy the rest of the video. So yeah, like I said, you want to be looking for relative equal highs and lows. It's a very important concept. Now, the next concept that I really enjoy using, and it's a lot more rare, but it's even more powerful, is exact equal highs or lows. So basically, you want to see on either ES or NQ, which is what I trade, you want to see 2 candles, 2 swing lows or 2 swing highs, or more even, that's even rarer, come exactly to the tick. So notice how the bottom is 22,178.5 on this candle, right? And that's on Thursday, June 5th. Now look on Thursday, June 12th, an exact week later, look at the low, 22,178.5. So the same exact low, equal lows to the tick. Now, notice how we end up making a move away from these, okay? Which is what you want to see, right? Because the more of a move away you can make from these to take out some sort of other internal range liquidity, the better target it's going to be and the better risk reward you're going to get trying to take a move back down to them, right? So we end up taking out this internal sell side right here, or sorry, the internal buy side, and we end up making an aggressive move all the way down to these equal lows. We take them out, like I said, very, very good move to the downside, which is perfect, right? So equal lows are very powerful. We had some more on the S&P 500 earlier this week, I believe, or like last week. It was actually a really amazing setup. So we had these equal lows right here, right? They were exact to the tick, right? 68.75.5 is the low on this December 3rd candle. And then if you drag it over on the December 10th candle, 68.75.5. It's funny how both of these sets have been exactly a week apart, right? It was Wednesday for these. The other set was Thursday. So maybe that's some algorithmic secret as well. But anyway, we had these equal lows. And notice how we strayed away from them. And this is actually a really good example. I actually did end up catching a short on this move. But so if you look, we create these equal lows, we make a strong move away from them. We actually end up taking out a ton of relative equal highs in the process of making that move away from the lows, right? So we take out all of this liquidity. And what ends up happening? We end up absolutely nuking down to these equal lows, right? It was just a clean move, only took a few hours. And that was an insane trade, right? Because if you had shorted, once we started getting some weakness, you could have had like a crazy R trade. And, you know, I actually ended up catching this move with options last week, the majority of it at least, right? So that's what we had. These equal lows, they got taken, and it was a very, very ideal target, okay? So equal lows, equal highs, you want to find them, and even on the lower time frames, the biggest thing with equal lows and highs is you want them to be several candles apart to the point where the space between them is pretty visible, even if you were to back up your chair 10 feet. And then if you mark them on the line and they're exactly equal on ES or NQ, don't look at MNQ or MES for this. Look at ES and NQ because those are the more liquid contracts. So like I said, that's one of the strongest draws in liquidity. Now we're going to go over one last one that I do find pretty helpful. So the last concept I want to go over is the Datawick. That's one of my favorite draws on liquidity. Now, what exactly is it? Well, a Datawick is when we have a news event, specifically at 8:30 a.m. or 10 a.m. Eastern. That's when a lot of red folder US news comes out. And we create a wick on the 8:30 a.m. candle from that news release, right? And oftentimes you're going to see us start to trade away from that. But as long as we leave a wick high or a wick low open, it's going to remain a very good target. So notice what happens here. We create this wick high. We start to trade away from it a little bit. We pull back into this 1 minute bullish fair value gap, right? We're combining concepts now, right? Because we displaced. Now we need to rebalance. So we rebalance, and look, you take longs out of here. You risk maybe a close below the fair value gap, and you target the Datawick. It's probably about a 1-to-1 trade, and you're getting a very high probability setup there, right? The reason is because these Datawicks leave a ton of unfilled orders when they happen, because there's such a high explosion of volume on these news candles to where you're going to end up likely drawing back to that. And notice how we did not leave any, you know, significant Datawick at this low, so we never come down and take it. But this is a very obvious Datawick, so we end up rolling back up, taking it out. And anytime you see a news release, especially like CPI, which was yesterday, or even I guess at 2 p.m. when you have the Fed meeting announcements, whenever you see a Datawick, or whenever you know there's a news event coming, I should say, look to see if you find a Datawick and start to pay attention to how they get reacted to and how they become basically a magnet for price. So with that being said, those are my 3 favorite draws on liquidity, explained as simply as I possibly can for you guys. I use these along with my trading model, which I have in a different playlist you guys can check out after this boot camp. But every time I take a trade, I'm looking for one of these draws on liquidity to be my target because they're very high probability. Not only that, but I'm making sure that in the case of equal highs and lows or relative equal highs and lows, that there's a very obvious sweep in the other direction before I target, right? Because what's the point in targeting relative equal highs when there's also a ton of relative equal lows, right? It can only be a strong high conviction draw on liquidity if one side has already been settled, right? So if sell side's been taken, you can target buy side. If buy side's been taken, you can target sell side. But you don't want to try to force a trade when you've got obvious sell side and buy side, and you're basically just ping ponging between it, because that's like, that's like gambling. That's like flipping a coin, because you're basically saying like, oh, we got two great draws on either side. I have no clue which one we're going to hit first, but I think this one because no reason, right? So don't do that. Always make sure you're only, taking draws on liquidity as a thesis for your trades if the other side has been mitigated. All right. So, like I said, if you're still watching this video, you're probably pretty serious about trading. If that's the case, make sure to join my free trading Discord. It is linked to my YouTube bio. Starting 2026, I'm bringing a lot of features. It's going to stay free, but I'm going to be live a lot. I'm going to give market commentary every day, and I'm going to be working hard to grow the community and make it awesome. So if you guys are interested in that, that'd be awesome to see you guys in there. I communicate with everybody. I respond to everybody, all that stuff. So appreciate you guys for watching the video. I'll catch you in the next one. Peace.